Eddie, I asked you years ago, and it was about conventional financing, and you told me, you can't build your business off just conventional financing. This question, if it doesn't apply to you now, it will, and someone submitted it online too. I have a W-2 income, but my loan officer said I do not qualify because I'm self-employed and the income on my tax return is too low. What can I do?
We're talking long-term financing or short-term financing?
Yeah, this point's long-term.
Long-term financing to hold properties for rentals. Mm-hmm. Well, I think you got a couple options, but the most viable today, 2022, is the product that did not exist as recent as 4 or 5 years ago. And we call it non-QM. That means non-qualifying on your income. It's Wall Street money. Jet Lending does them. Our friendly competitors do them. We write the 30-year paper, and we send it all to Wall Street. It's the same bucket of money that used to supply back in 06, 07, 08, until it collapsed, was the subprime. It's all Wall Street money. So here is the key to non-QM. They're 30-year fixed mortgages. The rate fluctuates based on your credit and loan to value and debt service coverage ratio. Everybody kind of understands credit. I think everybody probably understands loan to value. The one people don't necessarily know quite as much about is debt service coverage ratio. Now, I just said your loan rates fluctuate on those. That's also their underwriting guidelines. That is it. It's credit, loan to value, debt service coverage ratio. So let me explain debt service coverage ratio just for a second. Most of them are around 1.2 to 1.25. 1.2 means if your payment is $1,000, it must rent for $1,200. Okay? If it's a 1.25 and your payment is $1,000, it must rent for $1,250. You normally know your payment or you know your rent and you solve for the other one for your qualification. If you know it rents for $1,250 already, then that means your max payment you're going to qualify for is $1,000. So you pretty much got to have a 680 credit score to get in this game. Loan to value, the good rates start at 70. You're not going to get anything above 80, but when you go to 80, the rate's bumping up. A few weeks ago, these rates were around 4%, maybe low fours, but with everything going on, rates are on the rise. Your rates now are in the fives, but you're in the fives for a 30-year fixed rate mortgage on a non-owner occupied loan, meaning it's a rental, and you're not showing your income. Y'all, that's a pretty damn good product now, I'm going to tell you. You would have loved that product for years, for decades, because it didn't exist. And it started to come alive 4 or 5 years ago. A lot of people, how many of you have never even heard of this? Oh, see, there you go. And it's very, very prevalent out there now. And it's growing. They are extremely finicky. It's Wall Street. When COVID Monday hit, Monday, March the 9th, 2020, they all shut down. And they weren't back playing the game with us until June or July. That's how finicky they are. But it's good and healthy now. It's called non-QM, mean non-qualifying on your mortgage. But that's where most everybody goes now. The ones that don't go there will go regional banks, the Allegiance banks, the Texas Citizens banks of the world around town. You can go there. That's where most of my rentals properties are financed at. And if you don't go there, if you can show your income, you still go the old Fannie Mae. But we used to do a lot of Fannie Mae's, but those are going by the wayside because there's almost no difference between the interest rate on a Fannie Mae and a non-QM, and the non-QM is faster and easier. Did that answer? Is that fairly clear?
No, absolutely.